My name is Adam Baziri. I'm a lawyer at Direcall. I'm going to give you what I consider really to be a high-level overview of fintech and what I have identified to be a number of trends within fintech. From my experience, I've spent 4 years advising mainly blockchain companies. Um, I entered into this industry as a lawyer because I was interested in fintech more broadly. Also, at the time, I was aware of Bitcoin. But when I looked into Bitcoin more, I saw that actually this technology was going to be the most disruptive force within fintech. And here, when I talk about disruption, um, it's not in the same way that, for example, uh, disruption, artificial intelligence is of course going to disrupt jobs within various industries. But what is very peculiar about blockchain is that it targets certain intermediaries within an industry, financial services, and replaces their function with this technology. And it replaces a very crucial function, which is trust. And trust is the fuel of the financial economy. And so it's that phenomenon that struck me, and that's why I've spent most of my time looking at blockchain technology. So what I'm going to do is just give you what I consider to be the two strands of fintech at the moment. Um, that's broken down into two aspects. One is institutional efficiency, and the other is external disruption. Um, then what I'm going to do is look at some of the environmental factors involved in this burgeoning industry. Why is it, that London appears to be such a prominent place for fintech, um, and other countries are encouraging fintech, but are not attracting the human capital needed or retaining that capital. So those are some environmental factors that I've identified based on just observation. To be honest, a lot of it is common sense. Um, and then there's the regulatory influence, which is a really important aspect of fintech, because at the end of the day, without we're talking about a tightly regulated industry, and that therefore, if regulations go against the use of technology for an existing business model, or the use of technology to disrupt an industry in its totality, then that technology will not reach its zenith, it won't reach its potential. So regulation is actually a very important factor in considering the future of fintech. Um, that's not to say that there's anything alarming at the moment. There are a few aspects that are slightly concerning in certain areas of fintech, but broadly, uh, most countries are encouraging this particular industry, and it's for one, very basic reason, which is countries, at least in the Western world, um, need to consolidate their intellectual capital, um, and need to keep jobs at home, um, and to do so, they need to invest in that IP. And technology is the way to retain some competitive edge in globalized markets, and it creates jobs. Entrepreneurs being situated in your country, they're going to be recruiting people and developing specialized talent. So there's of course a government imperative behind this industry, which is favorable in the sense that trickles down to the regulator that will take a more pragmatic approach to what startups are wanting to do. So let's have a quick look at those strands. Now, I think just for housekeeping, it'll probably take me about 15 minutes approximately to go through, 15 to 30 minutes, I guess, to go through this presentation. So the first strand is what I view to be institutional efficiencies. And so here I'm looking at really the process of harnessing new technologies to pursue existing business models. So by that, you can take an example of a bank. A bank wants to achieve cost savings. It wants to achieve possibly greater speed, which all of those aspects are there so that it can achieve greater margins. And that same driving force is true in a bank as it is true in practically every other existing business. So the use of technology is to achieve those goals. And so it doesn't really matter about what technology we're talking about, so long as they can provably achieve those goals. So if artificial intelligence can provide a better algorithmic trading bot, or provide a better investment advisory service because it's more consistent and standardized, then of course those technologies, if scalable, will lead to greater cost savings and possibly better customer satisfaction if it can lead to a consistent result. So my view is those technologies, they serve to the extent that it achieves institutional efficiency. Now, that would suggest that an institution is actually a fairly innovative beast, but that's not the case. Innovation is not particularly top down. Yes, you could say, Apple, a behemoth in terms of size, and they've continued to innovate whilst being so massive in scale, which is hats off to them. But we find, at least within the financial services industry, it's a fairly traditional, fairly conservative industry, and that you don't get any prizes for innovation and having a fancy phone or fancy product. So what we do find is that it's the startups leading the way in terms of being innovative. But their innovations, I view, at least within this sector where you're using AI, big data and things like that, those innovations really are all about institutional efficiency. Effectively, if they do their job well as a startup, they will be acquired by existing incumbent institutions. And their technology will be internalized into those incumbent institutions. Now, here I'm not casting judgment over what type of fintech is a good type of fintech. Actually, it's irrelevant. It's just that there are trends in terms of the effects that we can observe, and one trend is all about institutional efficiency. The second trend is, well, there are aspects of efficiencies in effect, but it is actually about disruption. And so let's look at that aspect for a bit. What we see is that, or what we have seen is that certain technologies mature over a lifetime. The internet existed mid 20th century. It matured in the 90s, where people started to use it in a commonplace way. And that, it took a long time, between, the mid 20th century to the 90s. That's a long time for that technology to mature. But when it reached that point and, it popped its heads above the surface and people knew about it, then it's almost like a chain reaction. There was no way of stopping the impact that that technology would have on the world. And that's how I view blockchain. It's one of those technologies, like the internet, that have been sitting kind of in the back of people's minds. Cryptographies have been working on these alternative systems, and then it reached a flexion point with Bitcoin, where it proved itself, and as a result of proving itself, it then went into the cycle of maturity. Now, are we in the 1950s or in the 90s for blockchain? Don't really know, but one thing is for sure, is that the speed at which a technology matures is a lot faster than previously, because obviously you have this kind of Moore's law effect within new technologies. So we're seeing exponential improvements in these technologies, exponential progress of these technologies, which will mean, even if we are considered in the 1950s in 2009, by 2016, 16, we're probably already in the 1990s in terms of blockchain and its potential. So what is the impact? Why is that not just all about internal, institutional efficiencies? Because the impact of blockchain is that it actually displaces our whole industry. It removes the need for certain functions that are being performed within an industry, and we'll go into that in a bit. So with external disruption, we're talking about a technology that matures, but at the same time, external disruption occurs when a need presents itself. And that's, here we're not talking about two mutually exclusive concepts. Both can be true at the same time. You can have a disruptive technology that's maturing and a need that disruptive technology addresses. So if you felt, for instance, that your bank wasn't serving you well in terms of payments and that international payments were a bit too expensive, Bitcoin provides an alternative and is a disruptive technology in itself. But when a need presents itself, and a great example of that for fintech is when the financial crisis led to credit being drying up. And we saw that as a result, alternative credit markets started to arise. And the best example of that is the peer-to-peer lending market. That market arose really, it span out of the financial crisis. Yes, you had other areas, for example, payday lending facilities, which maybe not as palatable, but in any event, because there was a need, solutions arose. And those solutions didn't arise from the actual institutions themselves, the incumbent institutions. So that presents now a real alternative, and as a result of being a real alternative, it becomes a disruptive force on these incumbent institutions. So going back to blockchain, from our point of view, it represents a monumental disruptive event. So if we look at Bitcoin, it is a payment system without a central intermediary. It means we are used to thinking about payments where we send an instruction to a bank. The bank is responsible legally for channeling that instruction and is responsible for the delivery of the payment to the beneficiary. This comes through the law, but it is executed through technology, but the technology is very cumbersome. A payment instruction, an international one, goes through a series of various intermediaries and steps before the beneficiary receives it in their own account. But with Bitcoin, all of those intermediaries are stripped out, and it allows a person to transact with another person at a peer-to-peer level. And so as a result, Bitcoin removes the need for the bank as the first intermediary in that process. Um, so what we can see is if we take that concept of disruption and we then extrapolate it and use that same concept and apply it in different industries, we can see that this technology will lead to unbundling within all different other areas of finance outside of payments. So if it is true that Bitcoin removes the need for a central intermediary for payments, such as a bank, the same is true when you take blockchain technology and you apply it to the stock market. Do you really need a clearinghouse? Probably not. Do you really need a depository institution? Probably not. Not in terms of those functions. But, the law provides a role for them because that's the way the law has been designed at the moment. Obviously, the law will update itself in time, but we'll touch regulation in a moment. But the key point here is once Bitcoin proved that it was not necessary to have these intermediaries and you could still have a functioning payment system, then you could extrapolate that the same could be true in other areas of finance. So it has a massively disruptive effect. And so let's look at why it is disruptive, the mechanics of it. Conceptually, in a financial industry, the biggest currency is not national currency, it is trust. Trust is the biggest currency of finance. And that comes back to how this industry actually originated, where, for example, the insurance industry consisted of people that were underwriting contracts individually and then deciding, well, the risk is too great for me to underwrite that contract by myself, so I'm going to now work with other people who are also underwriting contracts, and we will form an association of insurers, and that is effectively Lloyd's of London. So that relied on those people trusting each other, trusting that they would fulfill on their promise, and that their promise was that, one, they had the capital to meet the risk if it crystallized, and that if it did crystallize, that they would pay. Trust is the currency of finance, and all of the infrastructure is built to achieve that goal, which is that you can, trust that when you send an instruction to your bank, that they will pay the other counterparty. That when you buy a stock on the stock market, that at the end of the day, you will receive a share certificate. But what is imperative is, with respect to blockchain, is that where trust was required and was provided by intermediaries, human intermediaries or institutional intermediaries, now trust can actually be provided through technology, in effect, blockchain. So the natural consequence of that is that you don't need any more of these traditional intermediaries, and as a result, their functions are displaced. So that's why, at least from my point of view, as I moved into fintech and I discovered blockchain, and then I extrapolated the consequences of this technology, I saw that this is by far the most disruptive technology within this industry. So let's move away from blockchain for a moment and move away from this kind of disruptive influence or trend within fintech. We've seen kind of the institutional efficiencies angle trend, and we've seen the disruptive trend within fintech. But why? What are the other elements involved in creating a favourable fintech environment? And that comes really from environmental factors. So here we're talking about having great entrepreneurs in a certain situation, having fantastic technology. So when I mean fantastic technology, it means that the bar to entry is very low, because the lower the bar, the easier it is for people to innovate. An example of which is, I talked about it earlier, blockchain. With blockchain, you now can build your own bank, frankly, or something that is a surrogate of a banking institution, with a fraction of the cost. And that's accessible, and you can write that smart contract code within weeks, frankly. So by lowering the barrier, you make it a lot easier for people to innovate, and which is a kind of truism in a certain way. Another aspect that is an environmental factor is the level of support in that environment. So, is the either legal system or the capital in that environment, is it rewarding people for taking risks? I mean, certain basic things in certain countries in the world. If you go bankrupt, you'd be sent to jail. That's not a great place for an entrepreneur in general. In addition, venture capital, needs to appreciate the risks involved in innovations in fintech, and that means understanding the dynamics of, say, a highly disruptive technology such as blockchain. And what is really interesting to observe is there can be very fickle or trivial, what appears to be trivial factors that can change an environment of innovation within fintech. And one such is immigration. Very, very basic thing. If your immigration system doesn't allow for talent to come to your country, and for that talent to stay in that country and not just spend 5 years and have to leave, then there isn't a permanence of that culture. It doesn't stay. It comes and it goes. It becomes expat as opposed to local entrepreneurs. People that come, do their job, then leave. And that culture takes time to generate. And that's why, if you take all of these elements and these ingredients and you look around the world and you observe which parts of the world can be like the capitals of fintech, you start to identify that there are these kind of factors that come into play. I mean, for example, the UK, Ireland, places like that, Berlin, they are fairly open societies. They have the rule of law. They reward people for taking risks in terms of there is capital there to a certain extent. And that the entrepreneurs establish and they stay. And so the culture becomes self-perpetuating. And so you need those kind of like those centers to emerge. And from those centers, the innovation is created in those local environments. Obviously, they're looking at a global market, but when they're created in the local environments, you start to see where those trends go. So are they more disruptive, or are they more about institutional efficiency? I can say for sure, Berlin, London are very key towards blockchain disruption in a very big way. A lot of blockchain engineers are based in those areas. And as a result, the regulators in those areas are fairly receptive to those innovations. Switzerland is doing quite a lot as well to encourage blockchain innovation. So innovators are moving to that area because they feel safe. So, and there are other trivial things that can come into play, and one is, an incidental fact, which is that you're in an English-speaking country. That can facilitate things to a certain degree in terms of where people want to situate themselves. Now, those are environmental factors that can encourage the culture of fintech. But another thing that can encourage or direct or actually destroy fintech is regulation. Now, we saw earlier that, for instance, um, blockchain displaces the need for central intermediaries in terms of their functions, but their role can be entrenched in the law. So we talked about a securities depository agent. Their role is entrenched 100% in the law, and so you can't just remove them completely. Even if the technology removes the need for them, they still have to perform that role because the law wills it. So there is a game of catch up in terms of regulation, and certainly not in the short term are you likely to have these institutions suddenly disappear because the technology removes their need. But if we look at regulation, and from my experience, if you want to encourage fintech, either if you want to encourage institutional efficiencies or you want to encourage even disruption, there are a few aspects that come into play. One is that capital will not move into fintech easily if they feel that the risks are not manageable. Yes, I mean, venture capital is willing to take a risk, of course, because that's the ROI, but at the same time, they want to know to an extent that those things are manageable because they're making their money to a certain extent from the scalability of the business. And if regulator is going to shut them down in 3 years, then that's not a particularly scalable business. So, to an extent, regulation comes into play where you need to define or manage these risks. And because by giving some clarity over those risks, you allow the capital to flow in. And the regulators themselves have a big role to play in terms of how they direct the industry. And they'll send signals out, and those signals will have a kind of chain reaction within the industry. And that could be as simple as a simple announcement or speech where you might have the head of MAS in Singapore that does a speech that says, our sandbox environment is open for all entrepreneurs, including blockchain disruptive business models. We welcome all of you guys. Just a simple speech like that can send a wave around the world, which will be picked up on Reddit on various forums and will now become part of the decision making of an entrepreneur where it's deciding to set themselves up. That's how powerful regulation can direct fintech locally but also globally. And so there are really 3 key areas, and this is here we're taking the local lens on a regulatory approach. One is the regulator being proactive. And in that sense, we're talking about a framework environment. Either they create a formal framework, which is, maybe regulations around payments in virtual currencies. Or they may take an informal approach, which is a sandbox which exempts institutions from regulation. Now, let's rewind the clock a little bit back to the beginning of the presentation. I said that there are 2 distinctions: one is institutional efficiencies, and the other is external disruption. Even with incumbent institutions, for them to embrace a highly experimental technology like AI or Internet of Things, no one really knows where these technologies are going. They need some level of reassurance, even though the impact is just simply internal. They just generate better data on their customers, which allows them to make better decisions on when to produce the product, which reduces the amount of cost that they need to maintain that custom. So those are internal in terms of the benefits. But still, there's a lot of risk in them embracing a highly experimental technology. So the sandbox is that kind of formula to allow one, disruptive technologies to take shape and see where they lead and grow. On the other hand, to allow institutions to embrace not disruptive, but experimental technologies that have an internal efficiency gain. So that's the proactive lens. The non-interventionist lens is more about information gathering. So here we're looking at a regulator that's looking at the industry in awe and trying to understand it, and not seeking to actually intervene, either by creating frameworks or not, and just observing how that industry is looking to develop. And once that industry achieves some level of maturity, using that evidence produced and information generated to then devise policy, and then the third point is selective. So here we have a government that is taking a kind of varied approach towards the technologies that they want to encourage and others that they don't particularly want to bring to the fore. And so, for instance, one way of looking at it is you have virtual currencies themselves present a anti-money laundering risk, and that trickles down from the Financial Action Task Force right down to now in the EU, the fourth anti-money laundering directive. These regulations are going to come into place and are going to change the environment for virtual currencies without a doubt and those businesses. Now, that has an impact on those businesses, but it's still the government's policy is to ensure that AML policies are applied across the board. It wants to encourage innovation, but it doesn't want to do that at the cost of other issues around public policy. On the other hand, blockchain presents a lot of potential in terms of its own requirement of understanding what regulated companies are doing. So it presents a transparency layer into these regulated institutions. And that they do see the efficiencies that these technologies present. So sometimes you'll find that a regulator may take a more selective approach where there may be, okay, well, we will regulate fairly stringently on AML, but on this area, in innovation, we're not going to touch it. We'll allow the industry to develop their own standards and develop their own ideas around this industry. So those are the three kind of prongs to regulation. So now, really to wrap this up, there are, as I said, two trends: the institutional and the efficiencies and external disruption. You can identify that environmental factors are key to encouraging or discouraging a fintech environment, and that's why people talk about fintech hubs, because they have those environmental factors, which are a combination of language, immigration, risk appetite of people, and an environment for risk, which means that people congregate, and that's that simple. And then as a result of that, they innovate, generate ideas, iterate the ideas, and build them out further, which means they interact with their local regulator, and the regulator reacts to those innovations, and that regulator may take, as we saw, a three-pronged approach of either being proactive to devise a framework, non-interventionist to observe, or selective in terms of, on the one hand, pursuing a public policy objective such as AML, but at the same time not intervening in a certain area. So those are my observations on fintech in a very, very high level way. I'm happy to speak in further detail on certain areas at a later date. But the key pointer is that To encourage this industry to grow, of course, it requires regulators to intervene to a certain degree, to lead the way, and sometimes not to intervene. It also requires key environmental factors, and even to generate some of those institutional efficiencies, it needs kind of this mixed environment of environmental factors, good sound regulation, and almost a standoffish approach in taking the leap towards new technologies. So those are some of my observations. I hope you enjoyed the talk. Thank you very much.